Section 3:1 Understanding the Volatility Index, VIX, Factors Affecting the VIX, 3.1 Options Pricing and Implied Volatility. The relationship between options pricing and the VIX is intertwined, as options pricing incorporates expectations of future volatility, which is a key component in determining option premiums. Here's a closer look at the relationship between options pricing and the VIX, implied volatility. Implied volatility is a crucial input in options pricing models, such as the Black-Scholes model. It represents the market's expectation of future volatility and is derived from option prices. The VIX, as a measure of implied volatility, reflects the aggregate market expectations of volatility over the next 30 days. Higher implied volatility leads to higher option premiums, as increased uncertainty and potential for larger priced swings increase the value of the option premiums, and the VIX. The VIX serves as a reference point for evaluating option premiums. When the VIX is high, options tend to be more expensive because investors are willing to pay higher premiums to hedge against potential market volatility. Conversely, when the VIX is low, options tend to be less expensive as the expected volatility is lower, reducing the value of the insurance provided by options. Vega is an options Greek that measures the sensitivity of an option's price to changes in implied volatility. When the VIX changes, it can impact the vega of options. Options with higher vega are more sensitive to changes in implied volatility. Therefore, as the VIX increases, the vega of options tends to increase, resulting in higher option premiums. Conversely, when the VIX decreases, the vega of options tends to decrease, leading to lower option premiums. VIX as an indicator for options trading. The VIX can be used as a tool for options traders to assess market sentiment and make informed trading decisions. High VIX levels may indicate an opportune time to sell options, as higher implied volatility leads to increased premiums. Conversely, low VIX levels may suggest a favorable environment for buying options. As lower implied volatility tends to result in reduced premiums, options as a tool to trade the VIX. In addition to the relationship between options pricing and the VIX, options can be used to directly trade the VIX itself. CBOE offers VIX options and VIX futures that allow investors to take positions on the expected future level of the VIX. These derivative instruments enable traders to speculate on changes in the VIX and manage their exposure to volatility. It's important to note that while the VIX provides insights into expected future volatility and its impact on options pricing, it should be considered alongside other factors, such as market conditions, fundamental analysis, and individual option characteristics. When making options trading decisions, changes in implied volatility directly impact the VIX as it is a measure of implied volatility itself. Implied volatility represents market participants' expectations of future volatility and is a key input in calculating the VIX. Here's how changes in implied volatility impact the VIX. Direct relationship. Implied volatility and the VIX have a direct relationship. When implied volatility increases, it leads to an increase in the VIX, and when implied volatility decreases, it leads to a decrease in the VIX. This is because the VIX is calculated based on the prices of options on the S&P 500 index, and as implied volatility rises, it raises the prices of options, thereby increasing the VIX. Option pricing impact. Implied volatility is a critical factor in options pricing. Higher implied volatility leads to higher option premiums as increased uncertainty and potential for larger priced swings increase the value of the option. As options prices increase due to higher implied volatility, it contributes to the increase in the VIX. Sensitivity to changes. The VIX is sensitive to changes in implied volatility. Small changes in implied volatility can have a magnified impact on the VIX. This sensitivity is reflected in the calculation methodology of the VIX, which uses a formula to estimate the expected volatility of the S&P 500 index based on the prices of different options with varying strike prices and expiration dates. Market sentiment indicator. Changes in implied volatility, and subsequently in the VIX, can serve as indicators of market sentiment. Increases in implied volatility and the VIX often indicate a shift towards more uncertain and volatile market conditions, reflecting heightened fear and risk aversion among investors. Conversely, decreases in implied volatility and the VIX can suggest a decrease in market uncertainty and a shift towards more stable market conditions. Mean reversion. The VIX has historically exhibited mean reverting behavior. Extreme readings of the VIX, whether high or low, have tended to revert back towards the long-term average over time. As implied volatility changes, it can contribute to the VIX moving towards its mean, reflecting the tendency of markets to normalize after periods of heightened or reduced volatility. It's important to note that changes in implied volatility can be driven by various factors, including market events, economic data releases, geopolitical developments, or changes in investor sentiment. Therefore, interpreting changes in implied volatility and their impact on the VIX requires considering the broader market context and other relevant factors.